Welcome everyone to our fixed income outlook for the month of August. Let's quickly review the month of July. As we all know that July has been all about a huge fight between the markets which are witnessing higher inflation and the central banks which believe that the current inflation is transitory in nature and they need to continue to focus on supporting the growth revival. In the US, the CPI inflation was recorded at around 5.5%, and the core CPI inflation was at 4.5%. Nevertheless, Fed at its meeting suggested that they believe this inflation is transitory in nature. It's comprised largely of two very large components directly related to the unlocking of the US economy at a rapid speed, which is the second-hand car prices and the housing construction raw material, mainly lumber or wood, and therefore they believe that once the economy stabilizes, those prices will start coming down. And then the commodity prices over the last 4-6 weeks have largely stabilized. Most of the commodities are either at the recent high or slightly below that. And given that, there is some suggestion from Fed that they would like to continue with the current policy stance of quantitative easing and keeping interest rates low. Fed also hinted about beginning to think about some sort of tapering if the current environment continues, but they wanted to see a more improvement in the labor markets. And that's where the market took a hint that Fed may not be as quick to hike rates as was initially anticipated. And we saw the 10-year in US come down all the way to 1.20% to hit the low of the month. And then it remained largely at around 1.2, 1.3 band, which is a significant shift down from the high of 1.75, which it saw in the months earlier, and then from a level of 1.5 where it traded for a long period. So I think the global markets have begun to give some sort of comfort back to the domestic markets. On the other hand, as far as India is concerned, the inflation continued to remain high at around 6.3%, though it was significantly lower at 6.26% as compared to the market expectation of somewhere in the 660-675 band. So that was some relief, but the core inflation still remains high. We saw some moderation in the WPI. However, the market was disappointed because of absence of any liquid benchmark paper in the first round of the government securities acquisition program that the Reserve Bank announced in early July. And from then on, we saw that the 10-year bond yield continued to inch up and ended the month at around 6.2%, which is around 15 basis points spike for the month. So while the Indian markets lagged in the early round of the ratcheting up of the global bond yields, some was made up. And the second important development was the change in the RBI's language from holding on to the current level of market yields to an orderly evolution of the yield curve. And therefore, I think we saw a bit of steepening of the yield curve with the short-term yields coming down and the long-term yields going up. At the end of the month, the market sentiments remained very, very subdued. The market participation, the secondary market activity levels have been coming down, and that does not give a very good hint for the month of August. We believe that the markets will continue to remain on the side of caution and apprehension. Therefore, we might see some bit of inching up of the yields again. The sustained RBI intervention has failed to bring any kind of a positive momentum. And therefore, I think it will be interesting to see how August pans out. But from the way the things are right now, one would expect the yields to move up by another 5 to 10 basis points, notwithstanding the fact that the global markets may continue to stabilize. Fed has indicated that they may hint at timing of the taper starting sometimes in the next meeting, which will happen in September. But let's wait and see how the markets evolve. It's a very interesting time for the fixed income markets. Everyone believes that interest rates should go up, but because of the strong central bank intervention and because of the largely stable fundamentals at the macro level, bond yields have remained in a range. The yield curve continues to steepen somewhat because of the excess liquidity in the system. The short-term rates are finding good support from the investors. It's a very interesting time to launch the Mirae Asset Money Market Fund. And this money market fund will largely be investing in money market instruments, as the name suggests, of up to 1 year. And the money market curve itself is pretty steep right now. The 3-month yields are somewhere in the 3.30-35 band, and the 1 year yields are somewhere in the 4 to 4.25% band. Therefore, there is a 70 to 75 basis points steepness in the money market curve. And therefore, in the current environment where there are apprehensions of the interest rates going up, there are apprehensions about the credit quality in different portfolios, the money market fund that we're planning to launch will have a roll down strategy where we are looking to invest in money market instruments of between 6 months to 12 months. And then as and when the maturity of those instruments fall below 6 months, we will book capital gains wherever available in that and shift the portfolio again into the closer to 1 year security. So I think if the interest rates do move up sharply, there will be a lesser amount of damage or decline in the NAV, and therefore the fund will be able to invest the maturities and fresh flow into higher yields. The key difference between money market fund is that it will have a maximum maturity of any single security of 1 year. And therefore, essentially, it is going to provide a good downside protection in case of the interest rates going up sharply, but it will continue to provide a steepness of the yield curve benefit if the yields remain stable or they do come down. We look forward to a reasonably successful launch of our NFO, and I believe in the current market environment that product has a very strong proposition. Thank you so much and wish you all the best.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.